Today we're going to discuss about the partnership formation. So this is the continuation of our videos in partnership accounting. A contract of partnership is consensual. It is created by the agreement of the partners which may be constituted in any form, such as oral and written. However, Articles 1771 and 1772 of the Civil Code require that a partnership agreement must be made in public instrument and recorded with the Securities and Exchange Commission or SEC when number 1, immovable property or real rights are contributed to the partnership. Example, land and building. Or the partnership has a capital of 3,000 or more. The underlying question in partnership formation is how do we record the capital contributions of the partners? The following three cases will be explained through illustrations. Okay, so first problem, A, B, and C form a partnership by contributing 100,000, 200,000, 300,000 respectively. The partners agreed to distribute profits and losses in the ratio of 3:3:4 respectively. Question, how much shall be credited to each partner's capital account upon formation? Case number 1, no other information was provided. So to solve this, A, B, and C total. So A contributed 100,000, B 200,000, C 300,000. So that's for a total of 600,000. If no other information was provided, then the amount contributed by each partner will be the same amount that should be credited to each partner's capital account. So the answer would be the same, 100,000, 200,000, and 300,000 respectively. In this case, we are not going to refer to the partnership profits and losses ratio. Okay, so the final answers would be 100, 200, and 300,000 respectively. Same problem, but case number 2. The partners further agreed to bring their capital balances in proportionate to their profit and loss ratio. For this case, we are now going to refer to the profit and loss ratio because partnership is bound by agreement, so we have to follow. Okay, so A, B, and then C, and then total. For case number 2, we are going to use the bonus method. Okay, so A, 100,000, B, 200,000, C, 300,000 for a total of 600,000. They are sharing the ratio of 3:3:4. Okay, so next is we have to determine the respective capital account balances that must be based in their profit and loss ratio. So this 600,000 shall be multiplied by 30%, 30%, and lastly 40%. So 600,000 times 30%, that will give us 180. So 180 here, and then another 180,000, and lastly 600,000 times 40%, and that will give you 240,000. So this should be the capital balances of all the partners after formation. The difference will be accounted for as bonuses. So A will have a bonus of 80,000, while B, okay, will have a bonus from B amounting to 20,000 and a bonus from C amounting to 60,000. The total partnership capital using bonus method will not be affected. It is only a transfer within equity. So the final answers are 180, 180, and 240,000 respectively. Next, we have case number 3. Same problem, but with a different assumption. The partners further agreed to bring their capital balances in proportionate to their profit and loss ratio. So we have to refer again to their P&L ratio, but by additional contribution or withdrawal of cash by partners A and B. Capital balance of C will be used as the basis. So here, the partners wanted to bring their capital balances in conformity with their profit and loss ratio, but not by using bonus method, but rather some of them will either contribute or withdraw some amount of cash. So to account for this one, partner A, B, and C total. So again, 100,000, 200,000, and 300,000. A total of 600,000. Since we're going to use the capital balance of C, 300,000, the amount to be credited by C will be the same. So 300,000, if we're going to base in this capital account balance, we have to divide it by 40% to determine the 100%. And that 100% will serve as the basis for our total partnership capital. So that is simply 300,000 divided by 40%. That will give us 750. So the total partnership capital after the additional contribution or withdrawal of cash by partners A and B will amount to 750,000. Now we have to multiply it by 30% and another 30%. 750,000 times 30%, that will give us 225,000. Another 225,000. Okay, as you can see, partner A will contribute additional cash of 125,000, and then partner B will contribute another 25,000, but partner C will neither contribute nor withdraw some amount of cash because his capital balance is used as the basis. Now, the total partnership capital of course will be affected. Okay, and the difference is the total amount contributed by the additional contribution by the partners A and B. So that's it for problem 1. That is 3 cases. Next, valuations of capital contributions non-cash. So what will happen if the capital contribution consists of goods or non-cash considerations? Okay, so according to the rule, it shall be valued based on the stipulation in the contract, or in the absence of it, based on the appraisals made by experts, which are normally based on the current prices or fair value. In other words, for non-cash contributions, if agreed value is not given, the fair value will be used. So to illustrate, problem number 2, A, B, and C form a partnership by contributing the following. A contributed a piece of land with an original cost of 1.5 million, but the fair value is 1.6 million. B contributed cash of 200,000, while C contributed a delivery truck that was purchased at 500,000 a year ago. Based on the provisions of the partnership contract, delivery truck should be valued at 280,000. Question is, how much shall be credited to each partner's capital account upon formation if no other information was provided? Okay, so for partner A, we're going to use the fair value, not the original cost. So we have 1.6 million. For partner B, since the contribution is in a form of cash and we are going to record this investment at its face amount, 200,000. Next, for partner C, between the historical cost and the agreed value, of course, agreed value shall prevail. So the answer would be 280,000. So these are your final answers. There are times that the entire business of a partner is contributed to the partnership. So to illustrate, let's solve another problem wherein one of the partners contributed his sole proprietorship. Problem number 3, valuation of capital contributions, sole proprietorship. If a partner contributes his sole proprietorship or his business to the partnership, then all its assets together with its liabilities shall be contributed to the partnership. However, the assets are treated, of course, as an addition to the capital contribution of the partner, while liabilities are treated as deduction. So, addition and deduction. So to determine the net capital contribution of this partner, we have to determine the net assets. And that is simply the difference between the total assets and liabilities. This net assets is synonymous to the capital of the sole proprietor. So this is your 290,000. This will be our starting point for the computation. Okay. So to read, A, B, and C formed a partnership early in 2021. The agreement provides for the distribution of profits and losses in the ratio of 3:3:4 for partners A, B, and C respectively. Partner A contributed land with an original cost of 200,000 but an agreed value of 220,000, while partner B contributed cash of 180,000. Furthermore, partner C contributed his sole proprietorship with the following statement of financial position. Since partner C contributed his sole proprietorship, and this is the most complicated one, we have to solve for his capital contribution first. Okay, so partner C. So just like what I've said, the starting point would be the capital account balance of partner C. Okay. So the amount is 290,000. However, this amount 290,000 is subject to adjustments. And this will be your adjustments. So how do we deal with these adjustments? If the adjustments pertain to an asset, then it shall be it has a direct effect on the net assets or net contribution of the partner. So meaning, if there is an increase in asset, the adjustment will call for an increase also in net asset. So if there is a decrease in asset, then the adjustment would be a deduction to net asset also. While for liabilities has indirect or inverse relationship or inverse effect with the net asset. Okay, so if the adjustment would be an increase in liabilities, then it will be a decrease in net asset. But if the adjustment would be a decrease in liabilities, then the effect on the net assets would be an increase. Okay. So to account for these adjustments, so first, let's read letter A. Only 90% of accounts receivable are estimated to be collectible. So as you may notice, there is no allowance for doubtful accounts. So the entire 10% will be deducted from our assets. Okay, so AR, allowance for doubtful accounts. So your AR is 120,000. 10% is 12,000. Since it is a decrease in your asset, the adjustment to the net asset would be a decrease also, 12,000 pesos. Okay, next we have letter B. Equipment must be 30% depreciated. So as you can see, equipment has been depreciated already by 50,000 pesos only. So let's check if it will be the same as the supposed adjustment of 30%. So 30% times 250. So the adjustment would be, or the accumulated depreciation should be 75,000, but the sole proprietorship recorded only 50,000. So we have to depreciate the equipment by 25,000 more. So again, this is a decrease in asset in form of accumulated depreciation. So equipment accumulated depreciation 25,000. This is also a decrease in your capital account or capital contribution. Next, letter C. For letter C, accrued expense of 3,000 and prepaid expense of 10,000 must be recognized. So accrued expense, it is a liability account, and an increase in liability will call for a decrease in net assets. So there will be a deduction of 3,000 from our capital contribution. Next, prepaid expense is an asset account. This is an additional to our assets, and it is unrecorded in our sole proprietorship. So there must be an addition to our asset in the amount of 10,000 pesos. And lastly, letter D, liabilities will be assumed by the partnership. This statement, letter D, will be your presumption. So even if without this statement, the liabilities are assumed to be contributed also to the partnership, or the partnership will be the one to pay for these liabilities. Okay, so this is your adjusted capital contribution. So the adjusted capital contribution would be 290,000 minus 12 minus 25 minus 3 plus 10,000. That will give us 260,000. Now, let's go back to the contributions of other partners. So A and then B. So partner A contributed land with an original cost of 200 but an agreed value of 220. Of course, 220,000 shall prevail, while partner B contributed cash of 180,000. So the amount that would be recorded is of course equivalent to the face amount of cash. So that is 220 and 180. So this is 220,000 and 180,000. So for number 1, how much would be credited to each partner's capital account upon formation? The answers would be 260,000, 220, and 180,000 respectively. Okay, so for number 2, another requirement, assume further that the partners agreed to bring their capital balances in conformity with their profit and loss ratio. How much would be the partner's capital account balances upon formation? Okay, so after determining the adjusted capital, if there will be another statement, okay, such as this one, the partners further agree to bring their capital balance in conformity, these answers would not be your final answers. Okay, so we have to do the same thing that we have done for our previous problems. Okay, so this is your case number 2. Okay, so we have to use the bonus method. Okay, so 260, 220, and 180,000. So partner C, A, and B. So let's just write it again here. 260, 220, and 180,000. Total. So let's determine the total. 260 plus 220 plus 180. Okay, so that is 660,000. And they are sharing in the ratio of 3:4. So 3 for partner A, 3 for partner B, and 4 for partner C. So just like what we have done, we determined the entire partnership capital, 660. This will be the same because under bonus method, there will be no effect on the total partnership capital. So 660,000, multiply this by 40%, by 30%, and by another 30% to get the respective capital balances. So 660 times 40%, so it should be 264. And then 660 times 30%, so we have 198,000. 198,000. Okay, so as you can see, there is a deduction from the partner C's capital account balance in the amount of 4,000. And then from partner A, 22,000. And lastly, to partner B, a bonus to partner B in the amount of 18,000. Okay, so sorry for this one, it is an addition. Okay. Okay, so both partner C and B received bonus from partner A in the amount of 4,000 and 18,000 respectively. So the net amount of course would be 0 and it will not affect the total partnership capital. So for question number 2, the answers would be 264, 198, and 198,000 for partner C, A, and B respectively.